Yes, let's kick off. Good morning and good day out there. Welcome, audience. Great you're here. And we have a new session about ethics, especially for corporate treasury people and ones who are interested in that field. Very much connected to the daily operations and the real life of treasurers, not so theoretical. And we live in dynamic times. We have a new president in the US. We have elections in Germany coming. We have a war that ended in the Middle East, one still continuing in Ukraine. And also we have quite a bit of a dynamic situation from an environmental perspective with the fires in California. It's dynamic, very dynamic. So as treasurers, we are risk managers. And what I would like to do today is to talk with the panelists about how to mitigate risk, specifically FX risk connected to real life events around the world and actual strategies applied. Let me introduce you to the panel today. Sunny, we all admire Sunny because she is from the US, so she got up really early. She leads the treasury of the social media and forum platform Reddit. I think most of you will know Reddit. Before she worked at GM and in financial services. Konstantin has a very long and solid track record in commodity firms and also has been in various countries that I just mentioned. He leads the treasury of STX Group, a global environmental commodity trader. So also from the environmental aspect I just mentioned, he knows, I suppose, quite a bit because STX Group trades renewable energy products and carbon credits. And last but not least, Tony is here. He is the one of the founders of Kantox, and they offer ethics management solutions. Perhaps you can tell a bit later about that also. And they do a lot beyond the obvious derivatives and the spots. Kantox now is part of the BNP Paribas organization. And I'm Pieter. I'm the moderator of the whole thing. Before we start, some practical input. The session will be recorded, so it will be distributed afterwards. The session lasts 45 minutes, and I'm strict in that. You can enter the chat box as well as the Q&A. So if you have thoughts you want to share with the rest of the audience, I will try to blend them in, and also questions. If there are questions, I will try to bring them into the session. So that's the introduction and the practical part. Let's kick off. Perhaps Konstantin, in the introduction, I already mentioned the environmental disasters. I think now the forest fires in the US are very, very prominent. And STX Group has a very strong environmental focus. Do you have examples of what's happening out there in the world, how it impacts your work as a treasurer?
Yeah, thank you for the question, Peter. Yeah, absolutely. So in a trading company, before you enter a deal, you need to evaluate its effectiveness. And a deal is basically a combination of buy and sell sides. And if they're in different currencies, then you face a fixed rate risk. And yeah, it would be very unwise to incorporate in your P&L calculation just current spot FX rate, because it's definitely going to change. And FX markets are very volatile. They're affected, obviously, by very many factors. And actually, it's not only the events that affect the FX markets behavior and dynamics, but also expectations and sentiments of the market participants, which count here. So, yeah, you mentioned natural disasters, you mentioned US elections. We can list other political and geopolitical events or situations. Yeah, central bank policies, releases of economic data. I would say everything, yeah, affects. Also, situation on other commodity markets, they are highly interrelated. For example, if you look at the ruble versus USD rate, it's heavily dependent on the behavior of the oil prices. And yeah, so all of these events definitely they affect the FX markets, but also it's important to understand that yeah, they're affected by expectations of the market participants and opinions of the market participants about the events or the consequences can differ a lot. And yeah, for some events, of course, it's easy to predict the consequence, but there are also events where different economists and different FX analysts would never come to the same conclusion. And also, of course,
sorry to interrupt you, but if I translate that to your situation at STX, your colleagues are traders.
Yeah.
They buy and sell, and perhaps they buy in one currency and sell in another. Can you also give a bit of insight what that means in your work? Do you have to do these traders come to you and say, okay, there are different currencies? Are they kind enough to share, or do you encounter when the deal is done?
Yeah.
And how do you mitigate it? How do you manage it?
Yeah. Of course, yeah. The traders are trading actually thousands of trades. Yeah. So if they come for every particular trade, it will not be possible to do it. So actually, it's a combination of two. There is a threshold. Yeah. Beyond, if it's below the threshold, yeah, it's basically. They enter data into the system, and then I receive a report, and then I act based on this report and other reports that we do. Yeah, but it's separate discussion how we evaluate exposure, of course, and what challenges you can face here. Yeah, but if it's above certain threshold, yes, it's best to approach the treasurer and check what is a forward rate, for example, yeah, for this particular maturity, because otherwise, it once again, as I mentioned, it would be very unwise to simply take into account current rate evaluating the future P&L effect of the trade. So it's a combination of two procedures, so to say, depending on the threshold.
And going to you, Sunny, you are in the US, and we are in Europe. We see what's happening. There's a lot happening, and also I think the social media are in the limelight right now. Do you have examples of what's happening out there that affects your work as a treasurer? Is it all a surprise, or isn't that correlation that strong that you see a direct effect on what you are doing in your work?
Thanks, Peter. I think you framed it very elegantly when you said, when you're trying to contrast, like, how does it work with STX versus, a US-based company with the global operations. I think I can speak for the US-based companies with global operations. The last few months have been periods of uncertainty when it comes to economic factors, and I think that's continue into 2025. Like you said, on one hand, we have a new administration and policy changes, but we also have to remember that US economic growth and monetary policies are diverging significantly from the rest of the world. 23-24 was a period of relative stability where I think all the economies were facing similar interest rate yields, currencies, FX rates were relatively stable. 3 months ago, we started noticing USD strengthening significantly. I think that is one of the biggest examples that I can quote is when you start budgeting for the next year, when you start planning for the next year, what have you considered for your FX? What have you considered from your, not just FX in the sense of FX rates, but how is it affecting your revenue, your costs? I think all of us have to now go back and have to reevaluate that situation given the significant strengthening of the US dollars and the volatility in the market. So I would say, I think we are all going back to the basics and reevaluating our FX exposures, as well as evaluating whether we have programs in place. Do we need a program in place? And is the existing program effective?
And are you then trying to do the crystal ball thing, or are you thinking of all scenarios possible, and do you design strategies for each and every more or less likely scenario?
I don't think I'm going to do the crystal ball thing. I think we need to understand what our risk tolerance is as a company. That is primarily the most important thing. We need to understand We understand the FX rate will continue to be volatile.
Mhm.
Is the existing threshold still, are we good with it? That's where we are.
Yeah. But that's I suppose also either the stress part or the fun part in your job, I suppose. Yeah. And going to you, Tony, because you have conversations like these all the time, and you have so many different types of companies. Can you perhaps tell a bit more about different industries and also the goals you see the companies have in their FX strategies?
Sure. And indeed, that's the fun part of my job, of being able to talk to so many companies. And besides two excellent treasurers, I think we have today in front two very good examples of that diversity as well, in terms of company, geographically situated, in terms of business model, and that ultimately lands on the way they look at FX risk. I think they both share a non-speculative view. I would say that's common, and that's usually the common topic you would, especially the higher you're talking to the companies, when you go to the CFOs or you go to the shareholders. In the end, FX risk management is nothing else that what a company needs for international resilience, right? You don't want to be hyper competitive and showing a super strong performance when your home currency is mega devaluated, if then in a couple of years that is going to be completely reversed in an event of an appreciation, right? So what you want to do with FX risk management is show that for the next 100 years, you're going to be delivering the profit of your underlying business, right? That's how I like to think about it. And well, I see them both of them nodding, so hopefully I'm not too far away from that. Now, the way to achieve this is completely dependent on that underlying model. Konstantin was telling us on how he needs to see on a daily basis the trades that the traders are doing, right? Well, Sunny is taking, well, we need to see the expectations of what are going to be our revenues in foreign currency in the next 24 months. The exposures, despite having the same goals and the same mentality to approach FX risk and wanting that resilience, is very different. And that's because in Konstantin business, and I speak under your control, Konstantin, but the business adopts a repricing strategy on a daily basis, right? If tomorrow the dollar appreciates, then if they're selling something that the subjacing is in US dollars, it will be more expensive and the market will have to accept it. Where on the other side, Sunny, the euro price of their services, is not FX dependent. So they cannot change the price every day based on the euro, right? So that makes it, I think, a very good example how, same approach, same mentality, but then depending on the business model, they need to be looking at very, very different things, and then managing the risk, one based on firm commitment transactions and the other one based most probably on a long-term rolling forecast basis.
Yeah, and that's a good segue to something Sunny mentioned in our preparation, that FX management is not solely a corporate treasury task. And I really am open for input from the audience there. But Sunny, can you elaborate on your remark that FX management is not only for you but for your colleagues?
Yes, Peter. I mean, FX management in a company, it will not work in a vacuum. It truly takes a village. It truly is a cross-functional effort. I'll bucket it into two broad items. For example, first aspect is, identifying and monitoring and forecasting your exposure. And the second one is, how are you going to manage those exposures? When I'm speaking about identifying and monitoring, accounting and FP&A become your key partners over here. They're able to help you identify what is your exposure in various currencies, what are your receivables, what are your payables, what's your revenue forecasted in foreign currencies, what are your costs forecasted in foreign currencies. They help you identify the exposures. Then obviously Treasury has to work through their policy and understand what is the risk given the standard deviations, and then have the FX management aspect of it, where you could have from the simplest side of intercompany netting to pooling to hedging. Whatever you do, each of these will touch multiple partners. I would say my biggest partners here are accounting, tax, and the legal teams. as I put any framework in place. Now, beyond these two on a regular basis, maybe not as regular as Konstantin has to go through, but on a fairly regular basis, I need to stay in touch with my business partners, which is on the procurement side, who has contracts which are like non-USD based, or sales teams who have a significantly large contract which is non-USD based. So that, you know, I need to continuously be in the loop with the business. So it's not going to work in the vacuum. It truly is a cross-functional effort.
And did you ever consider making your life really easy and, for instance, tell all your colleagues in sales that everything they sell should be in USD, or see if you can make anything like a natural hedge, because that would make your life so much easier? Would that be a way?
Natural hedges, yes. But giving a diktat that everything needs to be in USD is probably giving away a lot of our competitive benefit over there. But yes, I constantly keep thinking about, where do we have natural hedges? Do we have expenses that are in euro or to offset some of that revenue in euro? Or can I create, is there a reason for me to consider an expense in euro here? The contracts both on the procurement ops and the sales. So
because that's also one of the questions of James in the audience. He said, "What kind of exposures are what are you hedging? Is that something you can disclose? Do you have costs that you are actively hedging?"
I won't be able to disclose a lot of it, but then I would say think about natural hedges in your business, and that's the strategic way to go. Think about your intercompany exposures, and is there a way for you to offset some of that FX exposures? But beyond that, I think it's always helpful to go back to your own basics and work with partners like Tony or with your banks, what your exposure.
Yeah, and also now we go to back to Konstantin, because with his PhD, he might be, I'm not sure, he might be one of the smartest among us, although we'll find out. But you were talking about exposures not being that obviously and easy to understand, and I will never be able to repeat. But can you share with the audience your views on why getting insight in exposures is not an easy task?
Yeah, absolutely. Thank you for the question, Peter. Yeah, actually, I encountered at least two challenges with evaluating exposure. First is related to the data, underlying data, and second related to methodology that you finally need to define. So speaking about data, yeah, it's based on my experience in various companies. I could mention two challenges with the data. First is the data availability, and second is data quality. And speaking about, they're very, like, they go hand in hand, but maybe we can speak about them a bit separately. So speaking about data availability, think about situations when you have multiple subsidiaries in multiple countries. And these multiple subsidiaries, they have various ERP systems which stores the data. Some of these ERP systems can be very outdated and don't provide API connectivity, for example, yes? So people need to manually download reports. And first of all, if this manual job is spread in companies which are located in various time zones, you can imagine that, having at the beginning of the day a report from everyone, like, can be quite a challenge. And I don't even mention a situation when you need to, different ERP systems, they will provide reports in different formats. So you need to reformat them, you need to clean the data, you need to prepare the data. So, but even within one entity, if the life cycle of a contract is spread between different systems, for example, initially contract is entered into one system, but when it gets invoiced, it is captured in another system, then you will also face, even within a single entity, will face a situation issue with synchronization of the data. Very simple example, when contract has been delivered and but invoice have not been yet entered into accounting system, for example. Yeah, so of course at the end of the day or next day they will be fully aligned, but there will be definitely a time period when one system will show that the contract does not give any exposure, and another system will not have an invoice on that. So actually, this exposure related to this contract simply will disappear from your radar. Another example is we are moving a bit more to the data quality. So, and the data quality depends, of course, on the quality of the systems that you use, but also can be affected by imperfect processes or missing controls. Yeah, a very extreme and I hope very rare example is when you have your bank statement reconciliation on daily basis, but for some reasons, some of the lines on the bank statement are not reconciled. So you will end up in a situation when you double count. For example, you have received a revenue from your customer and you will see it's as a balance on your bank account. But at the same time, if this cash was not reconciled against invoice, then you will also receive the same amount as open accounts receivable item, and you will double count the same amount twice. So that's can.
Is that substantial? Perhaps that's also a question for Tony, because this is very much a also what Kantox, I suppose, encounters, and gathering data and interpreting data and making systems work together. I think Kantox has the strength. I understand what Konstantin is bringing forward, but is this also a top 5 priority and essential? Because it also for me connects a bit to the whole STP discussion. You can invest a lot, and technically there's a lot possible, but what problem do you solve? Is it a real problem? Can you perhaps also share your thoughts on that, Tony?
Sure. I'll answer more from a statistical point of view of what are the main problems that I see on on the companies that I approach. While we can discuss the specifics of what you mentioned, Konstantin, and go into the details, but I wouldn't say the exact problems you're mentioning is the main ones the majority of the companies in the market are facing. And I'll try to bring it very much to the basics, because for me, the general problem is that FX is considered a treasury topic. Sunny already explained how he's a cross-functional, and I think it all starts in the pricing. I think I get concerned when I ask a treasurer, what is the FX rate that is embedded in the price of your products or services? And they don't know. This is a real problem, because when, as we were speaking earlier, we want that international resilience that usually leads to we want to hold margins. Well, the margin is defined at the price. The pricing dynamics are extremely important to understand. And then we talked about natural hedging, but the word natural needs to be in there, right? And natural means that if I have a dollar payable because I'm buying, or let's say euro payable because I'm buying something in Europe, I should not offset it with revenue coming from the UK because I make that contract in euros. This is not natural. In the UK, your clients most likely would prefer to pay in pounds. So just because the UK is close to Europe, let's not force the contract in euros, right? So let's do natural business. Let's buy the products or the services in the currency that they are cheaper, and let's sell them in the ones that we have, we can be more expensive or we can be better comprehended by the client. That would be, I wouldn't say the lesson number 1, but I don't want FX behaviors to affect natural business. That's my point, and this is where I see the problems. When we have that approach, then as Sunny said, there needs to be a lot of cross-functional task of understanding that pricing, that business dynamic. And as Konstantin was saying, okay, we need to set up a process to detect those exposures, right? The first thing is we have identified, oh, this is our pricing, this is how it behaves, this. We have identified how the exposure is created into the business. Second thing we need to do is measure, which is a lot of what Konstantin was talking about. Is saying, okay, if I am not able to, if I need to keep stability on my pricing, then my underlying is going to be my long-term forecast or licensing agreements. I'm inventing it on Reddit, but let's say we say, okay, this is the revenue expected in the next 2 years rolling for licensing agreement on our data. Well, okay, then that does not need to be super precise. If then the way to act on it is I am going to hedge 4% of my expected revenue in euros of year 2, because that forecast can be 96% wrong, essentially, right? it is very different to Konstantin's point, which is I had a trader that bought for this amount and sold for that amount. Well, that is a very precise with a very precise number. And then the sources of revenue and the quality of that data is going to depend because I take a different action on it, right? And then Konstantin, I think, pointed to two things. One is the process can create exposure. If I generate exposure on a minute basis because it's trading, and I only, capture the exposure on an hourly basis, is the process creating the exposure. So, that real time is needed. Where, again, different to Sony, which is saying, look, if I am looking, of course, we want to look at the shorter time exposures because that is going to give us a much better accuracy on the short term. But when I am hedging 20% or 6%, I don't really need that real-time basis. And that is going to determine a lot of the processes of the technological connections that I need to set up to achieve my goal, right? Which, again, a different policy in the end. So this, and sorry for making a long answer, but this is where I think this identifying, measuring, and then acting, and acting can be natural netting and say, oh, I need to hedge my cost, I need to hedge myself. Well, that is the moment of finding that natural netting, right? But let's say we should internally ask for the hedge on the payable and the hedge on the receivable, and then match.
Yeah, and for me, being the least treasury person here, I can imagine that, and also I would like to hear your thoughts on that, Sunny, is also you have to know who you're talking to because you have to understand all perspectives. It could be that your sales director is looking at upping the revenue, whereas your CEO wants to perhaps mitigate risk, and your CFO wants to have the single source of truth and the reality there. Do you encounter this kind of discussions? Because there's a bit of a conflict in there sometimes.
Oh, yes, Peter, all the time. I think the objectives are always, the sales team has its objectives, run with their program, generate as much revenue as possible. And like Tony mentioned, and it's very fair, they shouldn't be worried about the FX. That is our job as the finance people, as the treasury team. It's our job to work over there. But there is constantly this tussle between what does sales want to do? Where do they want to grow versus what is the risk that we have considered as part of our forecasting or budgeting process? Same with the procurement ops team. They would want to go ahead and find the cheapest source for the labor or cheapest source for the material, and that may not be in our case in USD. And we need to make sure that we understand what would be my trade-off if I do want to switch to the USD objective over here. The objectives are always going to be conflicting, and I think it is on us to understand what's the best course of the business over here, and then try and get that information and understand how do we manage to that end. Data, I would so totally back Konstantin's comment over there. Having the right data is so important when you're trying to make these decisions, and then that's where comes our learning curve as the companies continue to grow. Have to understand that we need to get the right data being plugged in the right places.
Yeah. And also what happens there, I've got a question from the audience, specifically also for Konstantin. Anuja says, Konstantin, could you please share how you manage situation where there's a mismatch, such as a deal maturing, but the invoice is not received? Do you standardize such things? Do you know what to do, or is it one-off every time?
Very good question, by the way, very good one. So first of all, you need to create a preferably automated mechanism to detect such situations. So that's because you cannot act if you don't know. You can think that your new exposure is the right one, but it's simply a wrong one because of some data error or the situations that was mentioned. So actually, how you do this, in trading company, you should do your FX evaluation, exposure evaluation daily basis, and you need to really understand for yourself what are the reasons why it changed since yesterday. So if it changed, you need to understand all the reasons why it changed. And if there are certain big amounts, especially beyond certain threshold, that you cannot explain, most probably that's maybe some error is in. Yeah, as you need to investigate that. That's once again, you should be rather either have a very good systems or very well equipped with the data skills. And then you will first detect the situation when you cannot explain something. For example, if you cannot explain that the exposure went up because a new deal was entered or because something else happened. For example, you cannot explain that exposure went down because went up because you have received the payment of your revenue invoice. Yeah, because it will it will lead to the increase in your cash, but it will decrease your accounts receivable. Yeah, so it's an actually zero effect game. Yeah, but if you investigated everything and that cannot explain your exposures, then you need to look for the errors. And in that case, you also need to have kind of a quick mechanism to detect these errors, and then you either fix them if it's possible quickly in the underlying data systems, or if it takes too long, then you need to make some manual adjustment for this time, and then make a hedging decision based on you fully verified, validated information, and then of course chase relevant people to make it correct in the system. So coming back to your previous question, Peter, yes, you as a treasurer and a fixed risk management, you need to work with a lot of counterparties internally. You need to do a lot of educational work, not only with the front office and sales, but also with the people responsible for the data. You need to explain to them why it's so crucial that they do their work properly.
A lot of good insight from all of you, and there's a lot of people I expect in the audience who are having their New Year's resolutions as to strategizing in FX. Taking all in, Tony, and also what you see out there, what would be your advice for those who either start from scratch or want to re-evaluate their FX strategy? Where do you start? When do you involve your CFO? Is there a kind of a obvious plan for those who are perhaps not there where they want to be in FX management?
So I'll repeat a bit myself, maybe just also related to one of the questions that was just asked by James, would be to think in the currency that you want to make money, or your shareholders want to make the money, right? That's, I would say, is a big question. You don't need to move the headquarters or change a functional currency. You can be in Europe and say, look, the shareholders want their profits in pounds. That you can set up the risk management strategy towards this, right? But then it's going to be really understanding the business dynamics. I've already mentioned how the pricing is absolutely key on that sense. And then again, what you want to set up is a process where you want to have to run that process, the least human interaction on a daily basis, right? You want to have the systems where that information is recorded. For example, to the question that Konstantin was asking before, I would have said, look, if there is an invoice that is not paid, this needs to be reflected into the ERP, right? There needs to be a new expected payment, and that should trigger an automatic swap. And then when the cash is received, you can read that the cash is received, and you do another swap to bring back the currency. And we always need to differentiate the risk management decisions, which is coming from the expected transactions and ongoing of the business, and the cash management activity, which is usually linked to doing FX swaps to bring the maturity forward or backwards, right?
I was digesting there, and also multitasking, totally dangerous, because people were talking about sub-Saharan regions and everything related. I want to briefly stay away from there, and a lot of the audience members are generalists, and there's one thing we talked about in the preparation that was also relevant, because I see a lot of treasurers have an increased interest or even investment in time in investments. There used to be a standard time, cash risk, funding, that's a standard. Investments are increasingly becoming more important, and of course they are related. And perhaps Sunny, do you think, for instance, we were talking in our preparation about carry trades? Would that make the equation too complex and is it too much and too hard for most people? Or would you say, okay, there's a great strategy there and something the company can do to improve results? What would be your idea about that?
I think carry trades, unless you have a very specific business need to support, I would categorize that as being speculative. And I again go back to what Tony mentioned. Like let's have the business run naturally. If I am in the business of if I'm an asset manager or a hedge fund and trying to get that extra return, great, carry trades work for you. But I am not in that business. I'm a manufacturing company. I'm a social media platform. I'm a auto manufacturing company. I think we should stay away from it.
Yeah. And for those in the audience who don't know, I'm also kind of ignorant, but I know interest rates vary, FX rates vary, and the two combined can create an upside. And I can imagine, Konstantin, in your company, there are quite a few very smart people who would come to you and say, okay, my margin is X, but it could be X times 1.1 if we use carry trades. Do they ever force you to answer on that, or not really a topic?
Unfortunately not, but I'm fully with Sunny that actually, unless you are a bank or a very specific FX trading company, hedge fund, yes, as a classic corporate, you should stay as far away as possible from even thoughts about this, because once again, your primary objective is to manage the risk as a treasurer and to mitigate the effect of FX fluctuations and not try to earn on it, in a speculative manner.
I've been in recruitment for 30 years of treasurers. There used to be times that some treasury centers were profit centers, but I think it hardly ever or doesn't happen at all anymore. We have here a session that is called Your Currency Management Toolkit for 2025. I think we cover a lot, which is I think all good stuff, and I also see that the audience stays here, so that's a good sign. So I want to enter the last part of the session to give you all the floor, perhaps Konstantin first, and Sunny, and then Tony, and to share what you think should be addressed here as your currency management toolkit, and if there's anything specifically for 2025 which is relevant, and if you want to, you can perhaps blend in answers on what the audience is asking about a normal spread. I'm not sure if that's too detailed or cross-border payments, but perhaps I can invite Konstantin, your last, let's say, 2 minutes in this session. What should absolutely be in this session?
Once again, since I mentioned challenges surrounding exposure relation and how it's important to have a proper data skills in the team and also proper systems supporting you and proper other systems, not directly treasury systems supporting the underlying data, I think it's important to invest into this. Also, systems can help you also to minimize the spreads when you trade. FX when you hedge. So that's also Of course, I saw the question about what is the decent spread between maybe dusk spread for trading FX. First of all, it's depends a lot, of course, on many factors. From the volumes that can you provide to the banks to the creditworthiness of your company, because that's in the maturity of the forward transaction, for example. So it will be different for spot and for 6 or 1 year, and it depends on the currency a lot. For Turkish lira, you can imagine it could be very big. Or for some other currencies as well. So so definitely systems and data skills shall be invested into, and that's once again also invest into educational activities with other departments.
That's a good one that you mentioned it, because I think Tony will love your answer. Systemizing everything. Me as a headhunter, I blend in Yeah, of course, but also you need the people to understand the underlying processes. If you don't know what you automate, or if you don't understand what you automate, then of course, no use starting. So perhaps, Sunny, you can take over and share your last thoughts.
Yeah, I had two things that I wanted to say. Like 2025, that's going to be my most one. Konstantin already mentioned. I think invest in system, invest in data, invest in making sure that everyone has the right information at the right time and knows how to use it. And the second aspect of it is go back and reevaluate all your FX exposure models. Like, are you using a CFR, or are you using historical volatility, and is that truly still the right way to use it, or do you want to switch to the implied volatility? Leverage your consultants, your bankers, whoever is your FX partner, and refresh that model. And once the model is built and refreshed, don't leave it. You need to go back constantly to keep taking a look at it and reevaluate to say that, are we continuing to forecast, or are we continuing to stay within the bands that we have forecasted? Is there something that I significantly change in this? It's a constant work, and continue to invest in that one.
Yeah, good stuff. And I do recognize the skeletons in the closets from the past and policies there, also in for instance, governance. So good stuff. Know what's happening there. Tony, last but not least.
Yeah, so I mean, I agree with what my colleagues have said, of course. Indeed, like the comments. I would try to make it alive by saying, look, an Excel file is not a solid foundation for a good risk management practice. It's super tempting. It's so close. We all know how to use it. But this is a complex topic, and managing this in Excel is not sustainable. A small error costs thousands and hundreds of thousands of dollars, and is really very, very unlikely that is a tool that is going to be able. They've both mentioned how setting up the process of how to addressing those exposures is important. And by the nature of Excel, there is going to be lack of automation. You will need to click your way through that policy, and that is going to insert FX risk just in the process, right? My recommendation is always like, look, think when you are reevaluating your process, your way of approaching risk, think that you have infinite resources, right? Do not build a policy based on your current resources, because then you will not get investment. Think you have infinite resources. Show what is the delta between that world of infinite resources and the current situation. Show what is that difference, make that business case, and then you will be able to leverage investment to come as close as possible to that ideal scenario, which for sure will be very likely a massive difference in terms of exposure to risk, of opportunity, of scalability, of operating in more currencies, in more markets, or even being more competitive on the sales side, because you are able to reduce your implicit markups internally. And and many times also to reduce cost, right? Doing an initiative like this is going to be cost saving despite needing investment, and the payback is very, very often less than a year.
Yeah, and I can imagine in your work, it's relatively easy to at almost all companies to show your value add in risk mitigation, in getting extra transparency, in cost reduction, creating extra opportunities. So that's yeah, absolutely. I can imagine. Well, we are almost at the end of this session, so I loved it, because what I loved and what I take from this is making the topic of FX management less abstract, showing what's happening in real companies, what are real policies, and how FX management is done. And also, we didn't talk about the crystal ball. It was in there, the question, but I actually love it that we didn't talk about that, because it's always, it's guessing. And I think we should focus on stuff that we can influence ourselves. So thank you very much, panel. That was great. Sunny, Konstantin, Tony, good stuff. Thank you, of course, people of Kantox and of treasuryXL. There will be new sessions shortly on how to communicate with your CFO as a treasurer, how to have an impact. So I hope I see you in next sessions soon, and keep on following us on social media, newsletters, websites. and everywhere else. Thank you very much. Have a good day.
Thanks, everyone.